Good day, everyone, and welcome to our webinar for July month. Start in America as we usually do. There, the big news is that inflation has risen to 5% in May after April's 4.2% and March's 2.6%. So you can see there's a pattern of rising inflation in America. Wages are rising at 2.8%, and the so-called quit rate is up to 2.7%. The quit rate is the number of people who are quitting their jobs to find another job, usually at a higher wage. So it's also an indication of inflationary patterns in the wage payments. The Monetary Policy Committee in the Federal Reserve Bank and Joe Biden believe that this is a temporary phenomenon arising from the low base of last year, and that it should return to more reasonable levels. However, the MPC has adopted a more hawkish stance, and they've said that they will now raise rates in 2023 and not in 2024 as they had originally planned. And the US economy is growing at an incredible pace. In June month, it created 850,000 new jobs, non-farm jobs. That's up from May's 559,000 and certainly well above the forecast, which was 700,000. Hourly wages are up by 3.7% in June month. And the retail sales are expected, the year's retail sales are expected to rise by between 10.5% and 13.5% by economists. Americans are spending with a vengeance. Rising inflation, of course, is ominous and will definitely lead to an increase in interest rates sooner or later. So we once again draw your attention to the probability of a 10 to 20% correction on the S&P 500. We haven't really had a significant correction since COVID, so this is what we're anticipating, a fairly major correction. But that correction, when it happens, will obviously attract the attention of the doomsayers, the people who believe that the market is topping out and everyone should sell out of the market. But we believe that it will be a buying opportunity and not a new bear trend. While on the subject of doomsayers, in our article entitled "The Elimination of the Bears" on the 25th of January this year, we drew attention to a number of widely followed experts who were predicting the top of the market in America. Now, of course, 5 months later and several new record highs later, they are somewhat discredited. And of course, there's a new crop of doomsayers, but their numbers have thinned out a little. The bears are being eliminated. That is the point that I'm trying to make. When there are no more bears, of course, that is the time to really get worried, when nobody dares to stand against the market. So the US economy is rebounding, as you can see on the chart on your screen. You can see there the V bottom associated with COVID-19, and then the strong recovery since then. So the average S&P 500 company is expecting revenue to be up by 19.5% this year, and earnings to be up 62.8%. Of course, that is off a low base in 2020. But it shows that the recovery is well in hand. This has two implications for South Africa. First of all, it signals a powerful shift back towards risk on from risk off. And that's always good for South Africa because it means a flow of funds into emerging markets, and particularly into the rand, which is the favorite emerging market currency. It also means that the unprecedented world growth, which is going on in economies around the world, will lead to further strong rises in commodity prices. And that, of course, will be good for the rand, it will be good for South African unemployment, and it will be good for our tax collections and our budget. So that's what's coming out of America at the moment. Here back in South Africa, of course, we've had some political developments with the sentencing of Jacob Zuma. This will, of course, be an important test for South Africa's constitutional democracy. Zuma has made a belated application, which we believe is highly unlikely to succeed. And obviously, his incarceration is imminent. Ramaphosa is confident of the support within the ANC to deal with whatever opposition there was. And this is good news for the South African economy and its stock market. Blue chip shares on the JSE are generally seen as cheap by international investors, and the rand remains the world's favorite emerging market currency. Turning our attention to the local economy, the third wave of the pandemic is now well in hand. We've had up to 26,500 cases in a single day, mostly in Gauteng, of course. Hospitals have been filling up, and we've been moved to a level 4 lockdown, which we don't think will have a huge impact on the economy, except for certain specific industries like the liquor industry and the restaurant business. TERS payments will possibly resume for affected industries. Notably, Monte Casino has closed its doors for the full 2 weeks of the lockdown, which we believe may well be extended. We think the third wave will, however, have less impact than the first and second for 3 reasons. First of all, the South African population is by now has a relatively high herd immunity. Secondly, businesses and consumers have had time to prepare. It's not like the first wave and the second wave where we were still adjusting to the new situation. We've had time to prepare and to change our method of operation. And thirdly, of course, the rollout of vaccinations is gaining momentum, with some 3.5 million people already vaccinated, and the rate of vaccination is increasing steadily. Other news from the economy, of course, the decision to allow distributed electricity generation of up to 100 megawatts announced by President Ramaphosa is a game changer. It will change the South African economy radically over time. More and more businesses will choose to generate their own power. Harmony Gold Mine, for example, has decided now to expand its renewable power generation to 100 megawatts and plans to put in a further 120 megawatts, which it plans to sell back to the national grid. And of course, this unexpected move shows that Cyril Ramaphosa is feeling far more secure within the ANC. Magashule has been effectively eliminated, and Zuma is now facing imprisonment. They are really not a threat to him anymore. Load shedding should gradually decline as a factor in the economy as private enterprise starts to build its own electricity generation capability. It's estimated that approximately 5 gigawatts of power is available from the private sector over the next 18 months. We just think it's a pity that the decision was not taken earlier, because obviously it would have had a salutary impact even by now, and it might have avoided the load shedding that we've had so far this year. But better late than never. The first quarter of 2021 had a current account surplus of 267 billion, which is massive. And that is up from the surplus of 198 billion in the fourth quarter of last year. This, of course, is the impact of the recovering world economy that it is having on South African commodity exports. The surplus should continue to grow as the world economy continues to accelerate. This helps the rand to strengthen, and it means that the country is basically running at a profit. Historically, all South African economic recoveries have always been export-led. We expect South Africa to grow by about 5% this year, and we note that the international finance company HSBC is now predicting 4.9% growth this year. The economy is recovering somewhat faster than expected. The first quarter growth, just for the first quarter of 2021, came in at 4.6%, well above economists' forecasts of 3.2%, which vindicates our position and the stance that we took last year that the pandemic would represent a V-bottom. And of course, the major contributor here is mining. The official unemployment rate was unchanged in the first quarter at about 32.6%, and we think it's probably reached its highest level. Much of that unemployment, of course, is structural, and it reflects the employer-employee legal balance. In other words, the fact that the law in this country is skewed very heavily in favor of employees and against employers. This makes businesses scared to employ people because they can be so difficult to get rid of once you've got them. South Africa lost about 1 million jobs in 2020, and it will obviously take a few years to get those back. The jump in our CPI, our Consumer Price Index, to 5.2% is a bit concerning. That is obviously our inflation rate, and it's up from April's 4.4%. A large part of that is the cost of fuel, which jumped 42% from last May's unusually low levels. Of course, this is what they call base effects in economics. Last year was the base for that number, and it was very low, unusually low. However, we don't expect interest rates to be raised anytime soon. The government has told us that they will not be raised this year, and we don't expect any interest rate hikes until certainly the middle of next year. That would be our prediction. Government debt, of course, has risen sharply as a result of COVID-19 and the efforts that have been made to compensate for it. It's now standing at about 79% of gross domestic product, which is up from 63% the previous year, but considerably better than the 90% that was predicted. The government has been forced to borrow more from the capital markets, and we've reached a point now where about R1 in every 5 that is collected for tax is used just to pay the interest on our deficit. This, of course, crowds out other expenses like health and education. The rating agencies are warning us of a debt trap. Luckily, COVID has been accompanied by a rise in commodity prices, which we expect to continue into the future. So we are generally optimistic about the South African economy. If we turn our attention to the rand, I'd just like to put that chart on the screen for you. There we go. That's a 5-year chart of the rand, one which you should by now be familiar with. You will see the support level here at 15.30 to the US dollar, and then underneath here a long-term resistance line, which at the current time is about 14.50, but here was 14.40. And of course, the rand has now, from this strongest point here at 13.41, has weakened to 14.35 this morning. And there are two reasons for this. First of all, the Fed's sudden shift from saying that they will increase interest rates in 2024 to increasing them in 2023. This resulted in a switch from risk on to risk off in international markets, and that impacts directly on emerging market currencies, especially the rand. But the flow of strong results from the S&P 500 companies should counter that. Of course, the sentencing of Zuma is the second factor which has impacted on the rand. It is a victory for sanity in South Africa, no doubt, and for Ramaphosa, but it carries a significant civil disturbance risk, or the perception of such a risk. Some overseas investors are concerned that there might be civil unrest and even a civil war, but we believe that those concerns will be relatively short-lived. So we think that the rand will probably touch this resistance level here at 14.50, and the resistance will become support, and then it should track down back to lower levels against the US dollar in due course. So as risk off also switches back to risk on, and the Zuma fears subside, we should look at the rand getting stronger again. Overseas funds are looking for the high real rates of return that they can get from this country. Of course, now I'd like to just look a little bit at Eskom. Of the big news, of course, was the changing of the threshold to 100 megawatts. This reduces the demand for Eskom power, which means that there's less strain on the national grid, and that in turn means that we should have lower load shedding, or less load shedding in the months to come. In the longer term, businesses will move away from Eskom to self-generation. Renewables are now costing about 50 cents per kilowatt against Eskom's R1.66. So there's a strong economic reason why businesses would want to move to their own generation. So we believe that the generation side of Eskom will disappear over time, and Eskom will be left as just a distributor of power. Eskom is trying to formulate a plan to be carbon neutral by the year 2050. they've got some strong incentives to do this. The first one is that the European Union has promised to implement severe sanctions on companies which are, on countries which are thought to have an excessive carbon footprint, such as South Africa. The other thing is that there's a lot of international funding available for anyone who's trying to move away from coal towards more environment-friendly forms of energy. So they're looking to raise maybe $10 billion, which is about 140 billion rand. And that, of course, will help them enormously in the management of Eskom's 400 billion rand debt pile. Eskom, of course, is in the throes of a dispute with its unions. The Eskom management have offered them 1.5% as their best offer, and the unions are asking for 9.5 to 12%. I think it's fairly easy for Eskom to argue that they cannot afford that given their 400 billion rand debt pile. The matter has now been referred to the CCMA or the Labour Court for resolution. So we'll see what happens there. I think that in this case the unions will be forced to back down. All right, I've got a few general points that I'd like to just talk about. The first one is that the third wave of the virus probably means that the elections, which were slated for the end of October, will have to be postponed. Experts are saying that until we have got about 80% of people vaccinated, it's not really practical or sensible to hold elections. So it's quite probable that the elections will be postponed till next year, especially given the slow rollout of vaccinations. But we believe that by next year, Ramaphosa's position will be even stronger than it is now. The second point I want to make is to draw attention to the rampant cable theft and vandalism on Transnet lines. This is resulting in derailments and stopping about 30% of trains running, and that in turn is impacting on South Africa's ability to get minerals and metals to port. Exxaro reports that export volumes are down 10%. The police appear to be powerless to help, and the respect for law in Natal is at an all-time low, and this is probably connected also to Zuma and the Concord. Rio Tinto, which is another huge international mining company, has decided to close the Richards Bay Minerals Company after the fatal shooting of its CEO and further acts of violence and theft. This adds to the international perception that South Africa is a failed state. Richards Bay Minerals employed 5,000 people directly and affected the incomes of about 20,000 people in Natal indirectly. So that impacts on the local economy and also on foreign direct investment into South Africa. In a piece of good news, the Reserve Bank has received a rare accolade from the IMF, the International Monetary Fund. They've been described as a role model of independence, professionalism, and integrity. Governor Lesetja Kganyago and the governors before him have really done a very good job. They've refused to debase the South African currency since the ANC took power in 1994. Had they succumbed to the pressure that they've been under, South Africa by now would be like Zimbabwe. Now, our ultra-low inflation rate means that we can recover rapidly from the impact of COVID-19. Looking at the mining sector, the CEO of the Minerals Council, Roger Baxter, has pointed out that Botswana takes an average of 40 days to approve a prospecting license and 20 days to approve a mining right. South Africa, by contrast, takes an average of 245 days to approve a prospecting right and 355 days to approve a mining right. There's currently a backlog of 5,326 mining and prospecting rights which are awaiting approval. Gwede Mantashe himself, our Minister of Energy and Mineral Affairs, says that the system is a nightmare. But he, of course, has been there for quite a while. He's had plenty of time to fix this problem. So his competence must be in question now. The Bank of America has made an interesting prediction. they are saying that oil is going to reach $100 a barrel in the near future. So just looking at that, there's the chart of North Sea Brent oil, which you'll be familiar with. I've put it on the screen quite a few times for you. And you can see that there was resistance at $69 a barrel. That has now been convincingly broken on the upside. And oil has traveled up as high as $76 a barrel. Obviously, this shows that the boom in the world economy is continuing. There's increased demand for motor vehicles. And of course, all products throughout the world have oil in their cost structure, either because they contain an oil-based product or component, or because they've been transported in an oil-fired engine, an internal combustion engine of some sort, during their life cycle. Consumer spending in America is beginning to really take off. And as you can see here, there's a clear upside breakout in the oil price on the chart. So this supports our view that the S&P will continue to rise to new record highs. Okay, let's look at some companies now. I'd like to start with one of the new listings on the JSE, Thungela. I don't know if you know this company. It's actually Anglo-American's coal assets, which were unbundled and separately listed on the JSE and the London Stock Exchange. And they were formed into this Thungela company. This is a major exporter of thermal coal. It has 7,500 employees, and it owns 23.2% of the Richards Bay Coal Terminal. It has 7 mines in South Africa and can produce over 90 million tons of coal per annum. And as you can see here, trading began on the 7th of June over here, and the share has been tracking up steadily since then. So this is an interesting share to now bear in mind. We think it's quite a good one, actually. The next share I'd like to look at is Aveng. Quite a while back, I suggested to you that Aveng, this is a massive construction company which has been reduced to a penny stock, was worth looking at. Generally speaking, we don't recommend people to speculate in the stock market, but this particular company always had the potential to recover. We've thought so for quite a long time, for more than a year now. In fact, we advised you to get into the share at around 3 cents a while back. The day before yesterday, the share moved up to 5 cents, which is a massive gain in percentage terms, of course. The share is clearly risky. It is a penny stock, but it is based on 2 major operations, Moolmans in South Africa, which is involved in the mining industry, and McConnell Dowell in Australia, which is involved in construction work. It has a net asset value of 9.45 cents, and you can get it for 5 cents at the moment. Like I say, we did suggest you buy it at 3 cents last year, but we still believe that it represents a good opportunity. Maybe a little speculative, but it is a good opportunity. Eventually, of course, a share like this will have to do a share consolidation, probably a 10-for-1 or 100-for-1 consolidation, and in order to return to sort of more normal trading patterns. Anyway, Aveng, I hope you took advantage of it. We certainly did, and it's been doing well in the last few days. The next share I'd like to look at is ArcelorMittal. ArcelorMittal is South Africa's largest steel company, and it has survived where other companies like Highveld Steel have failed. Just looking over there, you can see we had a low point here in late July last year at 25 cents a share. But since then, the share has completed an island formation with a breakout. And here it is up at new high levels of 538 cents. So this share has gone up tenfold, more than tenfold in the last year. So it just shows you, if you find a share, a high quality share, when it's out of favor, you can often do very well from it. The next share I want to look at is ASPEN. ASPEN, of course, is a huge international pharmaceutical company. Just put a bit more data on the screen here. Okay, in the long term, you can see that this share was trading at 438 Rand over here in January 2015. It fell down to this level, found support at 243, but eventually broke down through that support. And then with the impact of COVID, went even further down. In fact, reached as low as 68 Rand in August 2019. Now it's in an upward trend. You can see a new upward trend developing here. And this, of course, is a Rand hedge share and should be worth investing in. We think it's on a recovery pattern. We think the recovery has still got some distance to go. The next share that I want to look at is a small IT company called ENTI, which you may not have heard of. It's a small technology company, but it's interesting because, just put a bit more data on the screen so that you can see the pattern here. It came down here to a low point of 7 cents, formed an island, and since then has been trading up to new high levels. It's now trading for 44 cents as of last night, and we think that it's in a new upward trend and has got some good potential. What is interesting is that in the results for the year to the 31st of March, the headline earnings per share was 9.3 cents, and the total revenue had increased by 20%. It has about 100,000 Rands worth of shares changing hands every day on average. So it's good for a small investment. That's really what we're saying, and it looks cheap. RCL Foods is the next share I want to look at, the last share that I want to look at today. This is obviously a large producer of food in South Africa. Let's just put a bit more data here. You can see that it's been in a downward trend for some time as the South African economy moved into recession, followed by the impact of COVID. But now there's been an upside break through the trend line. This is a company which produces foods, many different types of foods, well known for brands like Yum Yum Peanut Butter, Farmer Brown, 5-Star Maize Meal, etc., etc. They produce sugar and chicken, and they're 76.6% owned by the big company Remgro. And the share has fallen from 180 Rand to as low as 580 cents in September last year. Since then, it's been recovering. The results for the 6 months to December show revenue up 10.5% and headline earnings per share up 12%. It's broken up through its long-term downward trend line, and we think it's good for further upside potential. Finally, today, I'd just like to mention Lewis. This has been one of our favorite shares for a long time, and it gave a very nice on-balance volume buy signal, as you can see over here. But now the share is really starting to trend up, and we think it's on a good rising pattern. What is interesting about Lewis, of course, which is a furniture company, is that is a company which has no debt on its balance sheet at all. So it's very well positioned as far as we are concerned to take advantage of any recovery in the South African economy, and we would strongly suggest that you have a good look at this. Ladies and gentlemen, thank you for listening to me today. I hope you found something of interest here, and I hope that you have a good month, and I'll talk to you again on the first Wednesday in August. Thank you for listening.